Only 24% of Indian adults understand the fundamentals of saving, investment, debt, and budgeting.
Do you know what the number is in the United Kingdom? 67% adults in the UK are financially literate.
Understanding drivers of market is very important. Very first point is political stability and economy. Government should be formed and run by dominating party, so that it takes quick decision on progress of infrastructure and development. Let us see first point, what is repo rate? It is interest rate at which country's central bank lends money to banks. If repo rate is 4%, banks can lend at 8% interest rate to its customers and get a profit on the money. Reserve Bank of India, RBI, announces repo rates nearly 4 times in a year. When the repo rates are increased by RBI, banks' lending rate increases, hence companies having high debt must pay more interest, which lead to decrease in their profits. Investors won't be investing in low-profit companies, which lead to market fall. As the repo rate increases, individual investors can do fixed deposit and get 8 to 10% risk-free return in banks, hence they take their money out from stocks and put in bank. Hence market falls. Second point to be noted is inflation. Inflation is the most important term in markets, which represent fall in the value of currency. India imports oil, metals, minerals and other raw materials. When cost of these increases, cost of product increases. So we need more money to buy same product, which can be termed as fall in value of currency. Third point under section 1 is GDP. GDP is not directly related to market. However, it gives whether or not investors are enthusiastic about the future of the economy based on GDP data. The amount of GDP, particularly its growth or contraction, does have an impact on how the stock market performs. Check the Buffet indicator for valuation of entire market. The Buffet indicator is the term used to refer to the market capitalization to GDP ratio. In a December 2001 interview with Forbes, Warren Buffett stated that the ratio is a valuable measure for determining the overall valuation of the stock market, with a range of 75 to 90% being considered appropriate and over 120% denoting overvaluation. Second section is about FII and D2. FII stands for Foreign Institutional Investors. D2 stands for Domestic Institutional Investors. FII and D2 invest in large sums of money, unlike individual investors. They play a crucial role in market movement. Their investment is good sign for the company and market. FII and D2 investment data is available in moneycontrol.com. Third section is about events. COVID-19 lead to economic slowdown and has impact on markets. Recent earthquake in Turkey impacted the supply chain of oil, food grains influenced the market. War issues between Russia and Ukraine had influenced the Indian markets. I consider fourth section, oil and dollar value, is the most determining factor for market movements in India, as it can make or break. 80% of the domestic requirement in India is imported. Importing oil has direct impact on dollar reserves. Increase in oil price lead to increase in power cost, fuel cost and transportation cost. Electricity-based industries are the ones which take direct hit by increase in oil prices. Companies who cannot pass on to their customers has to face their margin decline. Companies with limited pricing power like cement, steel, logistics, airlines and automobiles will get impacted badly. Geopolitical issues has huge impact on oil prices globally. Oil is the basic source for most of the needs of countries, at least for India. Oil prices are determined by overall supply and demand of it globally. Demand is coming for all countries. Countries' GDP are growing, hence they need more and more oil. Supply of oil is controlled by governed body OPEC, which stands for Organization of the Petroleum Exporting Countries. Due to limited resources, supply cannot be increased as fast as demand. Petroleum products like plastics, paints, artificial rubber, synthetics, fertilizers and pesticides, solvents and pharmaceuticals are influenced by oil prices. One of the data points says that every $10 increase in oil translates to 0.1 to 0.3% rise in inflation. As we know, increase in oil price generally lead to falling markets. Generally, tech companies are shielded from the oil price volatility because tech companies are service-based online businesses. Another point to note is oil companies and power companies do well when oil prices increase. Also, we need to note that increase in oil price not always lead to fall in the markets. Market is influenced by many other factors.